Time to have a look at markets. Globally, markets have been roiled by fears of persistent high inflation, slowing growth and rising rates. So as a result, shares in Asia slipped in trade, with Japanese markets amongst the biggest losers. The Nikkei falling 2.3%. Markets in Hong Kong are closed for a holiday, while those in mainland China are closed for the Golden Week holiday until October 7th. Looking at what's happening on the European side, markets pulled back, tracking US and Asian counterparts as global stocks start the fourth quarter on the back foot. US stock futures pointing to losses for the market to start October after the S&P 500 notched its worst month since March last year. To give us more perspective, we are joined by Sean Morrison from IGSA. Sean, thank you so much for your time. Quick check-in right now on the JSE. I mean, looking at how we opened, how are we looking now?
Look, I think it was to be expected that we were not going to start on a positive note this morning after we saw quite a severe sell-off, especially into close in US markets. There are obviously a lot of risk catalysts in play, and when you look at it, of the 500 S&P companies that there are, we saw, I think it was more than 450 of those companies were down. So it's definitely a risk-off environment. You can see a spike in the volatility index, which just highlights what they call the fear gauge, fear within the market. And it's just reflecting here, and we're seeing it in the form of broad-based losses. So it's across sectors: financial, industrial, and resource. More pronounced in the resource space, less pronounced in the financial space, and that's maybe just because of we've had a bit of some strength returning to the rand after yesterday's trade surplus figures. Speaking of the rand, what do you make of the dollar's performance this week? It seems to have reached new highs. Yeah, so most of the influence has been, what's been happening with the dollar. The dollar has been breaking out against a broad range of different currencies, both developed and emerging. So the dollar has been strong. When you look at the rand, there's been some domestic catalysts. We saw that the domestic non-farm report, which was a little bit worse than people expected, saw an underperformance of the rand. But now, since that trade surplus started yesterday, we have seen some recovery. But in the short term, we've seen a pullback towards the 15 rand to the dollar mark, but that trend is at the moment towards weakening. So we'll see. I think a key level at the moment for the rand against the dollar, or the dollar ZAR, is 15 rand, and we're testing that right now. Yeah, what would you say were some of the key themes for you, especially when you look back at the week that was? I mean, all we've been talking about so far is the debt ceiling. Are you adding that to your list of themes for the week? Yeah, it's all the major catalysts are coming out of the two largest economies in the world, the US and China. So we've got the debt ceiling, which now they've provided some stopgap funding. So that has been kicking the can down the road, so to speak. China, we have the energy crisis. We also have in addition to that, we have this Evergrande debacle, which is lingering. Just going back to the years, I think one of the catalysts today is that we're expecting a vote on that infrastructure bill, and there's divide between Democrats, and that's now seen that vote delayed. So 1.5 trillion infrastructure bill, we're still waiting for that to be passed in the US. So if you had to compare, what's happening right now with the Fed 2-3 months ago, where in that Q&A session that Fed Chair Jerome Powell has with journalists, he wouldn't really touch on the idea of taper, let alone put a kind of timeline to it. And, fast forward now, it's a whole new different ballgame. And some economists have been saying that, there is a risk at the time, 3 months ago, that the Fed might be behind the curve because it seemed as though they were not too concerned about inflation. How have you seen that narrative change over the past 3-4 months or so? Yeah, so I think what the Fed has been doing for many years, and it dates back to the Ben Bernanke days, is they've been managing expectation and slowly managing expectation. So by the time we actually get to the event where we have the tapering in play, the market's already digested it and it's already priced it in. But certainly there is a more hawkish stance that is starting to develop. Tapering is coming sooner than was expected. When we start looking at interest rates, now interest rates are And I think the timeline to interest rates is under question at the moment. There are some suggestions that, that could even be pushed or pulled forward, into 2022, maybe the latter part thereof, instead of 2023. So definitely a more hawkish approach, but he's been slowly bracing markets for this and slowly managing expectation. We do need to bear in mind that equity markets have performed very, very well. Valuations are quite high, and we are sitting at top. So we are having a little bit of a tantrum at the moment, but it's not the end of the world just yet.
What are you keeping an eye on in terms of news events for the week or corporate news?
So with the themes that we've mentioned already, I think we need to keep watching. We need to see the systemic risk which can come from China through that Evergrande. Obviously, there's demand for energy from China as well at this point in time. One of the key mandates for the Fed in terms of the timeline towards tapering and towards raising interest rates is labor. Next week, non-farm payrolls out of the US will be a very important data point. The Fed is looking to, maximum employment, and to their maximum employment is 4.5%. So, and at the beginning of the week, we also want to watch we do have OPEC meeting, and so that could provide some volatility with energy, with the oil price as well.
All right, Sean, thank you so much for your time. That is Sean Morrison, who's a senior market analyst at IG South Africa. We're going to take a quick